Welcome to Breaking News to Trading Moves.
Good to be here.
Today, we are looking at a company that is often described as being right at the center of the semiconductor universe. We are looking at ARM Holdings.
The ticker is ARM, pronounced just like the word arm.
And they just posted their earnings. And I have to say, looking at the initial reaction, it's a complicated picture. On the surface, the headline looks solid.
It does. They posted growth. They guided next quarter revenue slightly above what the street was expecting.
And the primary driver they cited is exactly what everyone's been talking about for the last year. It's that continued AI momentum.
That's right. That's the headline story. That's what's keeping the bulls happy.
But as with most earnings reports in this sector, there's a catch. And this isn't, just a small footnote. It's specific enough that it's causing some real hesitation.
The licensing revenue.
Exactly. It's so they beat the total revenue number. The licensing revenue came in light. It missed the mark.
It did. And that is a crucial detail. It's not just a rounding error. It's a signal, really, about the health of their pipeline. To really understand the trade here, we need to get into why that specific line item licensing matters so much.
So the plan for today is pretty straightforward. We are going to map out the winners and the losers from this news. We'll span everything from the data centers to smartphone makers. But first, we need to get under the hood of these numbers.
Right. Let's look at the structure of the report.
Okay, so the headline is the guidance. The company is telling us that for the next quarter, revenue is going to be higher than the estimates. That's the bullish signal.
Yes, it suggests the AI train hasn't stopped. But to understand the cautious counter-argument, you have to look at the business model. This is where markets care about the distinction between royalties and licensing.
And a lot of people probably conflate the two.
They do, and it's important to break that down because ARM, they aren't a traditional chip manufacturer. They don't have their own foundries.
They sell intellectual property.
Correct. ARM sits right in the middle of the AI stack. Their business has two main engines. First, you have royalties. ARM collects these when chips built on their architecture actually ship to customers.
So a company makes a chip, puts it in a box, sells it, and ARM gets a small piece of that.
That's it. So it's the volume game. More chips sold equals more royalties.
Okay, so that feels like a lagging indicator then. It reflects work that was done, years ago?
Precisely. It's the harvest. You plant the seeds years prior, and the royalties are the crop you pick today. But then you have the second engine, which is licensing.
And this is where the miss happened.
Right. This is the revenue ARM gets when a company pays to use their designs to start building a new chip. And the reason the market fixates on this is that licensing is the leading indicator. It's the higher signal line item for future royalty streams.
I see. So if licensing is down today, it implies fewer blueprints are being bought, which means fewer chips are being designed.
Which means fewer royalties maybe 3 years from now. That is the fear. If companies aren't signing up for new licenses now, the pipeline could dry up down the road.
So what are the specific questions that miss raises?
The commentary suggests it raises questions about three things. First, near-term deal timing. Are deals just getting pushed back?
And in this environment, with everyone racing for AI supremacy, you'd think they would be rushing to sign.
You would. But these licenses are getting more complex. We're not just talking about a standard smartphone chip anymore. These are custom designs for massive data centers. The negotiations are harder.
So the complexity of the tech is actually slowing down the paperwork.
It could be. The second concern is pricing pushback. Are customers looking at ARM's fees and saying, no, not at that price?
And the third factor.
Third is customer mix. Are they relying too heavily on just a few giant players? So while the strong guidance supports the idea that AI spending is still very real, that licensing number is kind of a blinking yellow light.
It challenges the visibility of their future growth. Okay, so we have the setup. Good guidance, but a question mark on the future pipeline. Let's move to the winners and losers. Who benefits?
Let's start with the winners in AI data center compute.
Okay, so these are the companies that are adopting ARM-based CPU designs for those massive data centers. And this is a pretty new development, right? For a long time, the data center was purely by 86 territory.
It was. But that wall has been breached. The logic here is pretty linear. If ARM architectures keep gaining share in servers and AI infrastructure, two things happen. First, it supports more ARM royalty dollars over time.
Which we just talked about.
Right. But second, and maybe more importantly for the sector, it reinforces the entire ecosystem around ARM CPUs plus the GPUs they're paired with.
So it becomes a self-reinforcing cycle.
Yeah.
The more software is written for ARM servers, the easier it is for the next company to adopt them.
Exactly. It lowers the barrier to entry. When the ecosystem is small, the risk to switch is high. When the ecosystem is vast, the risk of not switching becomes the issue.
Okay, let's talk tickers. Obviously, the first winner here is ARM Holdings itself, ticker ARM, assuming they can close those licensing deals.
Yes. Then you have the big players in AI chips. First up, NVIDIA.
Ticker NVDA. Now, why is NVIDIA a winner here? They're known for GPUs, not CPUs. How does ARM's growth help them?
Because of how they are packaging their systems. Look at their Grace Hopper superchip. That isn't just a GPU. It pairs their GPU with an ARM-based CPU.
Oh, right.
NVIDIA is betting that the CPU handling the traffic for their massive graphics cards should be ARM-based. So if the ARM ecosystem grows, NVIDIA's integrated products fit better into more data centers.
Got it. It smooths the path for their high-end racks. And the next name is Broadcom.
Ticker AVGO. Broadcom is a master of custom silicon. As big tech companies decide to build their own chips, they often go to Broadcom to help design them.
And most of those custom chips are built on ARM architecture.
Almost all of them. So Broadcom is essentially the facilitator of this expansion. They're doing the heavy lifting to get these designs made for third parties.
Okay, moving on to the next group of winners. The hyperscalers and infrastructure platforms. The companies actually buying and deploying these stacks.
This is where the technical benefits really come into play. It's not just about having a different chip. It's about physics.
Physics, you mean like heat and electricity?
Thermal physics, specifically. The report notes that more ARM-based deployments can reduce power draw per workload.
Why is that such a big deal for a company like Microsoft or Amazon? Don't they have nearly unlimited budgets for electricity?
They have the money, but they don't have unlimited grid capacity. Data centers are constrained by power and by heat. You have a power envelope, a maximum amount of electricity you can pull.
Okay.
If you can lower the power draw for a task using an efficient ARM chip, you generate less heat, you need less air conditioning, and if you save energy, you can deploy more servers within that same power envelope.
So efficiency literally equals more capacity for AI. It isn't just saving on the electric bill. It means you can fit more brains in the building.
Precisely. It allows them to expand their AI capacity faster. That is the critical unlock.
That makes a lot of sense. So the winners here are the big cloud providers. We're looking at Microsoft.
Ticker MSFT. They've been very aggressive with their own custom silicon, the Cobalt chips, which are ARM-based.
Amazon.
Ticker AMZN. They were really the pioneers here with their Graviton chips. They've been proving for years that ARM works in the cloud.
And Alphabet.
Ticker GOGL. Their Axion processors are the latest entry into this race, following that same logic.
Okay, let's pivot to a sector that might not be on everyone's radar, but is listed as a clear winner. Chip design software.
This is the picks and shovels of the whole process.
We're talking about the tools used to create these complex chips. The report mentions EDA tools. Break that down for us. What is ED?
It stands for Electronic Design Automation. Think about it this way. You can't draw a chip with 80 billion transistors on paper. You need incredibly sophisticated software to lay out the circuits, simulate the physics, and verify it'll work before you spend millions to manufacture it.
And how does the ARM news help these companies?
The connection is chip complexity. As these AI chips get more advanced, they get exponentially harder to design. And because more companies, Amazon, Google, Microsoft, are designing their own ARM chips, there are more design teams needing these tools.
So you need better software to design them, and more people are buying that software.
You do. And you need to iterate faster. The analysis points out that faster iteration cycles lift demand for these EDA tools and verification workflows. If ARM has momentum, it means more people are designing chips, which means they need more software from these vendors.
It's a volume game for design licenses. Even if ARM's own licensing was a bit light, the general activity is high.
Exactly. The complexity is the driver. The harder the chip is to build, the more money goes to the software makers.
The names here are Synopsys,
Ticker SNPS,
and Cadence Design Systems.
ticker CDNS. These two effectively have a duopoly in this case. It's very hard to design a modern chip without them.
Okay, so those are the winners. The ecosystem is growing, efficiency is driving adoption, complexity is driving software sales. But where there are winners, there are usual losers.
Let's talk about the x86 CPU incumbents. This is the traditional battleground.
Which is primarily Intel and AMD.
Correct. The concept here is incremental share pressure. Every time an ARM-based server chip goes into a rack, that's a socket that didn't go to an x86 chip.
It's a zero-sum game for that specific socket.
Largely, yes. If ARM continues to make inroads, it pressures the incumbents in two ways. First, long-term unit share. They just sell fewer chips. But second, and this is painful, is pricing power.
Because if there's a viable alternative that uses less power, Intel and AMD can't just charge whatever they want anymore.
Exactly. It forces them to compete on price, which hurts margins.
The report also mentions something about difficulty for other architectures.
Right. It notes that stronger ARM momentum makes it harder for any newer ecosystems to win sockets. Customers prioritize mature tools and compatibility. ARM has that now. So it's not just hurting by 86, it's making it harder for something like RISC-V to get a foothold in high-performance computing.
It sounds like the moat that by86 had, that all the software ran on by86, has pretty much evaporated.
It hasn't vanished, but the bridge across that moat is wide open now. The software runs on ARM.
So the incumbents are feeling the heat. The names here are Intel,
Ticker INTC. They're in the middle of a turnaround, and this competition just makes it harder.
and Advanced Micro Devices.
Ticker AMD. They've executed much better than Intel, but they're still fighting the same architectural headwind.
Now, there is one more group listed as facing some risks, and that's the smartphone supply chain.
This is a bit more nuanced. It isn't that ARM is losing share here. ARM is dominant in mobile. The issue is the macro environment for the devices themselves.
The demand side. People aren't buying phones like they used to.
Right. The analysis cautions that despite the AI tailwinds in data centers, the mobile sector is exposed to demand hiccups.
What kind of hiccups are we talking about?
Risks like a pause in smartphone upgrades. If you hold on to your phone for 3 years instead of 2, that volume just drops. Or tighter component availability.
I think we were all waiting for that AI supercycle where everyone buys a new phone for AI, but that hasn't really happened yet.
It hasn't. And that weighs on near-term volumes. It slows down the pace of new silicon ramps. If the phones aren't selling, the chip manufacturers pull back their orders.
So the names mentioned here are Qualcomm.
Ticker QCOM, the biggest supplier for premium Android phones.
And Apple.
Ticker AAPL. Obviously, they design their own chips, but they pay royalties to ARM. If they sell fewer iPhones, ARM gets fewer royalty checks.
So we have a clear picture. Strong data center growth, questions on licensing, risks in mobile, pressure on the old guard. Let's talk about the trading angle. How do we look at this?
The report really outlines 2 distinct paths, and it depends on what the market decides to focus on. It's a battle of narratives.
Let's start with the bullish view.
The bullish view is that the market focuses on the guidance beat and the strength in royalties. If investors look at that and say, okay, the AI thesis is intact, then the whole AI and semiconductor complex could catch a bid.
Meaning prices go up, they treat the licensing miss as a fluke, a timing issue.
Right. It validates the growth story. It says the transition to ARM in the data center is accelerating, and that's worth paying a premium for.
And the cautious view.
That's where we go back to that licensing miss. If the market fixates on the licensing softness, the stock, specifically ARM, may stay choppy.
Choppy meaning it moves sideways, maybe with some volatility, but no clear direction.
Correct. And it might stay that way until management clarifies the licensing momentum. And also commentary regarding a March event that's been mentioned.
So there's a catalyst on the horizon people are waiting for.
Yes. The market hates uncertainty. Until they know if that licensing dip was a blip or a trend, the cautious money might stay on the sidelines.
It really comes down to whether you believe the AI infrastructure build-out is enough to smooth over the lumpiness in these big licensing deals.
That is the core debate. The structural move is the long-term story, but the quarter-to-quarter noise is dominated by these specific contract timings.
So to recap for everyone listening, ARM beat revenue guidance driven by AI. However, licensing revenue missed, creating some doubt. Winners are the AI compute stack, NVIDIA, Broadcom, and the hyperscalers like Microsoft and Amazon. The losers are the by86 incumbents like Intel and AMD, and potentially the smartphone chain due to demand risks.
That's the summary. A classic case of a strong long-term narrative facing some short-term execution questions.
And that's where we'll leave it, a complex set of signals from a central player.
It will be one to watch closely.
Absolutely. Before we sign off, I need to remind everyone this is not financial advice or buy or sell recommendations. This is purely the opinion of the author. Thanks for listening.